Alrighty, so now we're going to start to dive into supply and demand flip zones. So let me just quickly cast your mind back to, again, I always try and think, let's try our best to keep things simple, okay? Because it's very easy with what we're doing here with the amount of confidence that we can look for and multi-time frame analysis, two types of structure and all this stuff, it can get quite overwhelming. So always, if you try and cast your mind back to what is the logic behind what we're trying to do here, okay? When just thinking about supply and demand on its own, we're trying to look for a way I simplify it is where did big money step into the market? Okay, it's not quite true, but that's essentially what we're trying to think about. Where did that overwhelming imbalance between supply and demand happen? Right? If demand has stepped in, if demand's taking control, I'm trying to spot where that occurred so that when price returns to that area, there's a good probability, more often than not, that price is then going to continue that move from that area, right? Range, initiation, mitigation, continuation. Okay, cool. That's what we're trying to do. Now, when we drew those everywhere, the supply and demand zones everywhere, okay? So the main filter we use to try and look for institutional zones is we want to see that zone break at least some form of structure, right? At least break, like a fractal high or low, but at a minimum, okay? So that's the first thing we've been looking at is structure zones. So I've just drawn here a typical bit of price action where price comes up, and then we break this low. We look back for, there's the extreme zone, there's the supply zone, that broke structure, right? Demand fails, price just pushes straight through, and we can enter on that extreme zone that caused the break of structure. Exact same thing for demand, right? Price breaks structure, we look back, there's your extreme zone at the apex of the move, right? That led to the break of structure. Now, flip zones are basically, simplest way to describe it is where we see supply and demand have a bit of a battle, and then one overpowers the other. Okay, so simplest way to describe it is actually go back to the first example. So let's think about demand. Price makes a higher high, it pulls back to form a higher low, and that's confirmed when we get the break of bullish structure here. Okay, when that bullish break of structure occurs, we can then look back in this leg and we can see that there was some demand, right, that caused that break. Okay, happy days. So when price is pulling back, the simple expectation would be that this demand should hold, this should be a strong low, and demand will do its job, and demand should cause a higher high. But in this example, that doesn't happen. In this example, price literally just trades straight through it. It pretty much smashes through it. There's no reaction. It just melts through it as if it wasn't even there. So structure now shifts bearish. Demand has failed. There was no reaction, goes straight through. And now we have supply in control, and we can look to potentially short from that strong supply zone that led to a break of structure. Okay, cool. So the key sort of thing here is that there's no reaction, that we just melt straight through demand, right? This is a very, very similar scenario, except there is a reaction. And that's pretty much the only difference, okay? Everything stems from this reaction, and it will make sense in a minute. So price makes a higher high, it pulls back, and then it makes a higher high again, right? So we get that bullish break of structure, which creates this level of demand that led to the break of structure. Okay, you're with me so far, hopefully. So exact same as here. Price then pulls back into this demand level. And just like I said over here, at that moment, right, where we can't see the rest in the market, at this moment, if this is all we can see, it would be safe to assume that it's likely this demand is going to hold. And if demand does its job, what should demand do? It should cause a higher high. It should lead to another break of structure. Okay, so if price comes into this demand level and it reacts, for it to have done its job, it needs to break this high, okay? Now, ideally, you want to see it cause price to break and close above that high, ideally, okay? But if you get a wick break, you could argue it's kind of half done its job. And that will kind of become important in a minute, okay? In this instance, price comes into the demand and it does react. So the reaction is key because basically the reaction tells us that this is somewhat significant demand, that there were actually, enough orders from within here to actually contain price and to make price react a little bit. Like here, this is valid demand and it did cause a break of a high, but when price revisits it, there's no reaction. It just smashes straight through. But here we need to see a reaction for a flip. Okay. I just tried to make this clear because sometimes a lot of people can miss this part, and it's really, really key. So price comes in, it reacts, okay, but it never breaks the high. So demand doesn't do its job, okay? Now, we only have confirmation that it hasn't done its job once price breaks and closes below where the reaction started from. Okay, so I'll say that again. When you get the reaction and price starts to move up, if price doesn't break this high, so it doesn't do its job, when price then pulls back down and when it closes, so I need to see a candle body close below the start of the reaction, that is what we call a failed reaction. Okay? Again, I'm going to keep going over this many times. Price comes into demand, it reacts, it tries to do its job, but it fails to take out the high. Okay, but we only get the confirmation of that failure once price moves down and it closes below that dashed line. It closes below the start of the reaction. So at this moment here, if you now get a candle body closure here, what do we have? We have a failed reaction. And this is where we can say that demand, so this demand zone, has now flipped to supply. Okay, because this box I've drawn on, so from the low of the reaction to the top of the reaction, that orange, those two orange lines where we have the grey box, that is your supply zone. That overpowered demand. So that's buy before the sell. That's where the supply stepped into the market between those two orange lines to overpower our demand zone here. Okay? So again, we have demand, right? It's valid demand because it broke that high. Price comes down into it. It reacts. It fails to do its job because demand should make a higher high. But we only know and we only have confirmation that it failed to do its job once price closes below this low, right? Assuming that it didn't break the high. If price then comes back down and closes below the start of the reaction, we now have a confirmed failed reaction. I personally want to see a candle body closure, okay? And I would recommend you also wait for a candle body closure. Some people use wicks, that's more aggressive. And you can use it however you want. But I'm just telling you what I do. As of the time of recording, I need a candle body closure for a failed reaction. And I would just recommend that you start with the same. And you can test wick breaks if you want, okay? So at this moment here, if price is where I've circled it, we have the failed reaction. So we have the flip. But what we don't have is we don't have that let's say that change of character. We haven't had structure shift. Ideally, we want to see structure shift as well. Because, and this is the bit that can get, some people get a little bit confused with, but at this moment here, if price is where the circle is, we do have a confirmed failed reaction. Demand has flipped to supply, but there are still some orders left within this demand zone, right, below the reaction. And sometimes what can happen is you can get the failed reaction and you can get the flip, right? But there are still some orders from within this demand zone. Price could tap into here, right? Structure is still bullish because structure is between this low and this high. And sometimes it could fill up more orders and it could push up higher. Okay? So if we're looking to short and we want to short on the flip, ideally what we wait for, or what I wait for, is I also want to see structure shift. Okay? So we get the demand to supply flip. That is confirmed once we have the failed reaction, okay? But this demand zone itself only fails once price actually trades through it, okay? Because there still could be some orders. So a zone fails only once price trades through it, right? Which is what happens if price is down here. That's when the zone has failed, but the reaction fails when it closes below the start of the reaction. Okay, so hopefully that makes sense. So once we get that closure below and we also get the shift in structure, now we have a zone that flipped demand to supply and it led to a break of structure. So now this becomes a high probability area to look to get short on, because obviously you could also have the extreme zone up here. So this is where you can have two POIs, two supply zones. You get one that flipped the zone and broke structure, and you got one at the extreme that just led to the break of structure. Excuse me. But if there's a flip, that can also help us to look to enter on the flip, okay? So here, again, this is what we've been looking at so far, just zones that lead to a break of structure, right? There's no reaction there, so we look for price to come up. This is exactly the same, except there's a reaction in this area, right? So higher high, higher low, higher high. Price comes into demand. If demand's going to do its job, then it should make a higher high. But if it fails to break this high, right? And then as soon as price closes below the start of the reaction, so the FR line, the failed reaction line, as soon as we get a candle body closure, we can then draw on our supply zone from the start. So if you're drawing it on, you would go from the start of the reaction to the top of the reaction. Okay, that's your supply zone. And then ideally what we also want to see is we want to see the price trade through the demand zone, so the demand zone truly fails. Not just the reaction, but the zone itself. Once price trades through it, then the zone has failed. And obviously we get the structure shift as well. Now this becomes the high probable level to look to short from. Okay, because it's flipped demand to supply and it led to a break of structure. Right? Only other thing I'll say about these zones when you're drawing them on candlesticks, which we'll talk about in a minute and in the next lesson, is sometimes you can have very big price action. Like this could be a big move, like multiple pips. Price comes in, you get another big reaction, and then price moves down. And then if you draw on your zone, right, because remember the supply range is from the low of the reaction to the top of the reaction, sometimes this can be a very, very big zone. So it doesn't give us very good risk reward. So what we can do is we can refine it to like the pivot zone from within it, like the single candle, and you can refine it. But we'll talk about that in the real price action. I don't want to confuse you just yet, okay? So from a bullish example, we just think about a structure zone. Again, it's just one that leads to a breaker structure. Okay, we look back in this leg. Where are the zones? There's a zone here. Okay, that's the structure zone, right? There's no reaction. It's just one straight move up. Here, it's the same thing, except there is a reaction to supply, right? Price comes into supply. If supply is going to do its job, what should happen? It should push price to make a lower low, right? That's what supply should do. But in this instance, it has a reaction. And remember, there must be a reaction for there to be a valid flip. If price just goes straight up through, then there's no flip here, right? We need to see a reaction. So there is a reaction, which means there should be some supply within there. But that reaction fails to do its job. It fails to form a lower low. And then price breaks up and closes above the top of the reaction line. Once that happens, you now have a confirmed failed reaction, right? The reaction has failed to do its job. It's failed to make a lower low. So at this moment, you have a flip. And again, that's where you can draw your flip on, right? You take your box tool and you draw it from the top of the reaction here to where it starts to the bottom of the reaction. And then you drag it out to the right. And that is where the supply stepped into the market to flip demand, to overpower demand. And like I said, we also want to see it break structure. So now we have a zone that broke structure and it flipped supply to demand. And now this becomes a higher probable area. And again, if it's a big zone, you can refine it to the pivot from within it. Okay? And that's flips. Now, you can take that theory and you can apply it onto charts and you can kind of draw them everywhere and do these big expansive ones and make price action very, very, very complicated, which is a common sort of mistake I see. So again, we'll go into much more depth of this with price action examples in the future. But my advice would be try and just kind of stick to the ones that are simple and clean. They'll be obvious, okay? And that will come with time. But as long as you understand this theory, it makes sense. So just super quick recap, kind of the key points, the common mistakes I see is for a flip, there must be a reaction first, okay? So you need to see price react. As long as it doesn't break that high, as soon as price then comes down and closes below the low of the reaction, I personally want to see a candle body closure. We now have a failed reaction. But at this moment, if price is here, I know there's supply here, a demand to supply flip, but I'm not going to set my order on here. Why am I not going to do that? I need to wait for demands to truly, truly fail, not just the reaction, but the zone itself. And I want to see structure shift. Okay, I need to see that structure shift. Now I've got it. Okay, now I'm happy to get involved. Because remember, there's a small possibility that when price is here, it could fill up some more orders and it could continue and then you take a loss. So I personally want to see the structure shift as well. Okay, and then once you have that, boom, there's your flip, right? Now again, it's not 100% win rate like anything in trading. There can be times where the flip will fail and it will come up to here, okay? But we'll look at some other things to try and help us guess, or not guess, but try and anticipate whether we should enter on the flip or whether we should take the extreme, okay? Cool. So I just kind of put two examples here of kind of how this looks like, but again, we'll go in depth and more in the next lesson. But essentially, let's look at supply first, right? We have this move to the downside. So you could technically draw on your whole, use a box. You could draw on that whole range, right? You should be familiar with this now. You could go from the low to the high, and that would be your supply range. All right, but obviously in this example, I've refined it to the pivot within it, right? The inside bar. So when price comes back up into the supply at this moment, let me just zoom in a bit. Okay, so zoomed in a bit now. So when price comes up into that supply zone, right? We would just at this moment, we wouldn't know that this is going to happen, right? And we would assume, or we could safely assume that potentially that supply is in control and it will just continue, right? So what happens? Price comes in, it reacts. Remember, the reaction is key. But what does the reaction fail to do? It fails to do its job. It fails to make a lower low. So then as soon as price, so what you can do is mark out the top, right? If you want, if it helps you, mark out the top of the reaction. As soon as price closes above that failed reaction line, that orange line, you have a flip. It just so happens that that one candle that does confirm the flip, confirms the failed reaction, it also breaks structure in that one candle, which is happy days, right? So when that candle is up here and it closes, what can we now do? We can draw in our supply zone from the top of the reaction to the bottom of the reaction, And that is our supply to demand flip. And boom, there we go, right? Price comes back in, fills the orders, and goes. Now, you could have also refined. You don't always have to take from the top of the reaction to the low of the reaction. Obviously, there's like a pivot zone within it. So that inside bar, you could potentially refine to that as well. And then maybe you could have a bit of a tighter stop loss. But if I saw this example, I personally would still want to cover that low, just because sometimes price can come a little bit lower, fill up some orders from within there and go. But can you start to see now the theory, how it applies to candlesticks? Okay, they're always going to look slightly different, but it's the same framework. There's valid supply, price comes in, it reacts, it pushes up, comes back into it, and we go, right? Candle body closure and the break. So now let's take a look quickly at the supply example. So this is a demand to supply flip. So again, bullish market structure. This demand leads to a break of the high. Okay, so it's valid demand. Price comes into the demand. If it's going to do its job, what should it do? It should react and it should lead to a break of structure. It should break the high. In this instance, it fails to do so. So as it's reacting, right, if you're anticipating this flip, right, because obviously prices probably come into the supply zone and we're trying to anticipate that this is going to happen, you can then mark out the low of the reaction and you have to say to yourself, I need to wait for a candle body closure below that reaction. And again, just like the other example, in this instance, it just so happens that that one candle also broke structure as well, right, and completely cleared out the demand. So it all happened in one go, which very often happens. And then what do? We draw from our supply zone from the low of the reaction to the top of the reaction. And that is your flip range. That's your demand to supply flip range. And you can look to enter, or you could refine to the single candle, but sometimes you're not going to quite get tagged in. You see how it just misses it? And that's what can sometimes happen if you over refine. It is what it is. Okay, cool. Let's just look at kind of one example with market structure, the familiar example you'll be aware of, and then we'll hop on the charts. Okay, so this should be the multi-time frame market structure diagram you should all be very familiar with. So I'm not going to bore you to death with going over it in loads of detail, even though I do believe it would be probably beneficial for you just to keep getting that repetitive cycle. But if you're not familiar with it and you're not comfortable with it, please go watch the previous structure zone theory videos and also the entire market structure module. And I'm going to go through this a little bit quicker because it's all the same. It's just we've got flips in it and you'll see why. Okay, so bullish daily market structure, right? This is the multi-time frame one. So daily comes into supply. It reacts from supply. So we know when we come into a daily supply zone, we can look to play the daily pullback, but we know we're just playing the pullback phase. Price then will eventually form that higher high, that break of structure to the upside. Now, do you see how on a much bigger scale, what's happened? Price came into daily supply, it reacted, but it never broke any daily structure, never formed that daily lower low. So if price then breaks to the upside, what do you have? You now have a daily flip, okay? So you could take the whole range, right? You can draw it from the top of the reaction down to the bottom of the reaction. And now this is your whole daily range demand. It's the whole swing range, right? The whole swing pullback. That's your range demand from a structure perspective, structure zone. And it also flips this level. Okay, but obviously we can refine it, to what I call the extreme of the reaction leg. So this being the reaction leg from supply, and we can refine our flip down to here, right? And you see how it's the same thing as a structure zone, but if it flips supply like that, then it just becomes a flip as well. And there you go, right? Okay, let me just get rid of these orange lines so we can keep it somewhat relatively clean. Okay, cool. Then we come up into the next daily supply zone, which then initiates the next daily swing pullback phase. We get a daily, let's just say it's a daily change of character, which just so happens to be a 4-hour bearish boss, so the 4-hour changes trend. So we get a 4-hour swing lower low. This becomes our 4-hour strong high. This becomes our 4-hour weak low. As price is pulling back, we want to short and capture that 4-hour lower high to try and play that daily swing pullback, right? But when we do that, there's probably going to be multiple supply zones. I haven't drawn this on, but there'll be one at the top that ultimately led to the break of structure. And then like before, if you saw a pullback like here, that would be another structure zone. But if we look left and go, where did that reaction initiate from? This reaction here, and we can see that it came off a demand level, then what is it? It's a demand to supply flip, right? Price comes into demand, it reacts. As soon as we get the candle closure below there, we have the fail reaction. Then we also get the structure break, okay? And now this is a flip zone. So even if you had zero knowledge of flips and you never knew what they were and you just traded structure zones, a lot of the times they're going to be flip zones without you even realizing it, okay? And it's not some magical thing, but it just sort of increases the probability of zones when you get that on average, I find, okay? So that's a flip zone again. Same thing. We have a reaction from here, so there could be a zone up here, but then we get the flip zone, reaction on the flip zone, so on and so forth, right? And then we come down into the daily zone. We come up, we react from the 4-hour supply, right? So we could look for shorts from within here, but we know we have to be aggressive in management if we're doing that because we're coming off daily demand and it's likely we're going to switch bullish because the daily swing pullback is over, okay? But if that reaction then fails to break the low and then we move to the upside, all right, what do we have? We have a 4-hour supply to demand flip. So you can take your zone from the top of the reaction, right, and draw it down to the bottom, and that is your entire 4-hour flip range. But obviously, like I said, we can refine that flip down to the extreme of the reaction leg to just be a little bit more refined, and then you have your 4-hour zone. And then again, M15 comes in. What do we have? M15 supply, price comes into supply, it reacts, it fails to do its job, it fails to make a lower low. Demand steps into the market to overpower supply. We get the failed reaction, we get the shift in structure, and now you have your M15 supply to demand flip. And again, you can take it from the top of the reaction to the bottom of the reaction because that's your entire flip demand range, or we can refine it down to the pivot. And there you go. Okay. So I haven't gone super in depth in all of the expectations and blah, 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 but it's literally just the same as structure zones, except you're just looking for, was there a reaction? Where did it overpower it? And then that can show you as a flip. And because sometimes, right, you'll have an extreme like this that leads to the breaker structure, and sometimes you'll have the flip. And there you go. It's just another way of being aware of what's going on there and seeing that battle. So without further ado, let's hop on the charts and let's take a look at some real examples.